Imagine waking up tomorrow to find out mortgage rates have suddenly dropped overnight. But here's the twist. It might not be the good news you're hoping for. In the next few minutes, we are getting into the current economic conditions that could change everything for buyers and sellers in the last quarter of 2024. And trust me, if you are waiting for the perfect time to buy or sell a home, you'll want to hear this. Now, everyone loves to talk about the Fed and how they are the interest rate gatekeepers for the mortgage market. And that is kind of true, but just to a tiny extent, because it's not the whole story. If you imagine your mortgage as like a cake, it consists of a bunch of ingredients that have to be mixed together to make this cake. In the batter, we've got the broader economy. This is like all of your dry ingredients. So the elements in the mixture are things like GDP, employment rates, and spending. And mortgage rates typically go up as all these go up. And if those are down, we have a weaker economy, well, typically the response would be for mortgage rates to go down. Then we have our wet ingredients. We'll call this the policy-driven forces. Now, in this bowl, we've got bonds, specifically the 10-year Treasury, and that so widely touted federal funds rate. Historically, the mortgage market closely follows whatever is going on with the 10-year Treasury yield. The yield is the interest rate the U.S. government pays to borrow the money. As the yield or the amount the U.S. government will pay to borrow the money goes up, it increases the cost to borrow money, and therefore mortgage rates increase. But what causes the Treasury yield to go up or down? The simple answer is the economy and that super basic economic principle of supply and demand. What happens is that when the economy is strong, investors put their money into more aggressive instruments that are more likely to give them a higher return. They don't want to play it safe and tie up their money in a conservative investment like a 10-year T-bill. And when that happens, the demand for these bonds goes down. But the government needs that money. So they sweeten the deal for investors by increasing the yield and decreasing the actual cost of the bond. So in other words, when the economy is up, prices for the 10-year bond drop, so the yield rises to make the investment more palatable to investors. And in all this time, in all these things that we've discussed so far that factor into our mortgage rate cake, not once have we mentioned this thing that everyone talks about, the federal funds rate. Okay, now we'll mention it. So here we are, the federal funds rate. The federal funds rate is the interest rate that banks charge each other for overnight loans. Simply put, it's what banks have to pay to borrow money. And since banks don't lend money for free, they're going to charge more on top of their cost to lend money out. Now, the best customers of the bank get charged what's known as the prime rate. Each bank gets to set its own prime rate, but many banks use the federal funds rate plus 3 to establish their prime rate. The prime rate, and therefore the federal funds rate, affects short-term loans like adjustable rate mortgages, home equity loans, lines of credit, car loans, and credit cards. So for those in the back, the federal funds rate is really a driver for short-term loans, not long-term loans like a 30-year mortgage. Now, I don't want to totally discount the role the federal funds rate plays in mortgage rates. It does have a critical, albeit indirect, role in the broader economy, which, if you remember, is half of our cake. Because think about this. If it's cheaper to borrow money for short-term things, we spend more. So we put more money into the economy, which stimulates the economy to make it stronger. And we just talked about how that movement affects mortgage rates. So as you can see, there are a lot of factors, and so many of these pieces are closely connected. The moral of the story is mortgage rates are not just influenced by the federal funds rate. There is a unique blend of ingredients and influences that ultimately make up our mortgage rate cake. So this leads me to the bigger point of what I want to say to all of you federal funds rate chasers out there. What is a federal funds basis point worth to you? Now knowing what you know, how much emphasis should you put on that federal funds rate? Do you need to start tracking GDP, job growth, 10-year Treasury bills on top of the federal funds rate? Well, you could. I mean, you are watching this video probably because you're trying to figure out how to time the housing market. But here's the folly in tracking any of these to hit the market just right. You never know when the market has hit its peak or its lowest point until that time has passed. Yeah, those are only milestones you can know after the fact, once the market has shifted the other direction. Then at that point, you all too often find yourself chasing the market. You have to overcorrect in the other direction and end up either spending more or losing more. So to answer the question, how to time the housing market, well, you can't. You can make educated decisions, but if your need is to hit the timing just right, Odds are you won't. I mean, look at what just happened with interest rates. The Federal Reserve dropped the federal funds rate by 50 basis points. That's a lot. And mortgage rates actually went up right away. And when you look back on historical data, that actually happens a lot. I explained it in another video from the beginning of this year. Let's look at some of the past rate drops and what happened with mortgage rates at the time the federal funds rate dropped. Going back in time to a pre-pandemic world, it was 2019. The Federal Reserve lowered the federal funds rate 25 basis points at the July 30th, 31st meeting. For the week ending on July 25th, the average rate for a 30-year fixed rate mortgage was 3.75%. Then the federal funds rate went down 25 bips. But look at what happened to mortgage rates. They stayed flat. And then the next week, they did go down to 3.6%. Then at the next meeting on September 17th and 18th, they decreased the federal funds rate again by another 25 basis points. Mortgage rates leading up to that for the week ending on September 12th were at 3.5%. Then the Fed reduced the federal funds rate, but mortgage rates went up for an average of 3.73% for the week ending September 19th. Then for the following week ending on September 26th, they did go down to 3.64%. But let's look at one more example to see if we can see a pattern. The Fed met again that year on October 29th and 30th and reduced the federal funds rate again another 25 basis points. Well, the average mortgage rate was 3.75% for the week ending on October 24th. Then the Fed meets, lowers the federal funds rate, but then for the week ending October 31st, mortgage rates are higher at 3.78%. However, the following week, ending on November 7th, they go down to 3.69%. What we see is that a reduction in the federal funds rate is not a one-for-one with mortgage rates. So waiting for the federal funds rate to drop with the expectation mortgage rates will drop at the same time will actually end up costing you more. The data shows you actually should not tie your real estate decisions to the federal funds rate change announcements. And I know it feels like the market is playing a game of opposites, but the reason, well, the mortgage market adjusts based on economic expectations of multiple forces, and they often adjust ahead of time. So what should you do? Well, there's an old saying that goes, time in the market beats timing the market. And what this means is that over time, being in the market rewards you more than the potential gain you could make by a singular, perfectly timed event. Because here's what you have to gain by getting in the housing market now: building equity. Over time, as you pay down your mortgage, you increase the equity in your home, which contributes to your net worth. Not losing money to a landlord. Instead of paying rent and contributing to someone else's wealth, mortgage payments allow you to build equity in your own asset. Home price appreciation. Historically, home prices tend to appreciate over time, meaning your home's value can increase, offering potential financial gains when you sell. Using your home as an investment vehicle. A home can be a long-term investment that grows in value and can be leveraged later for retirement. A hedge against inflation. Homeownership protects you from rising rent costs and serves as a hedge against inflation, providing stability over time. Tax benefits. Homeowners can benefit from deductions on mortgage interest and property taxes, reducing taxable income and offering financial relief. Fixed housing cost. With a fixed rate mortgage, your monthly housing payment stays constant, offering predictability compared to fluctuating rent prices. Emotional security and stability. Owning a home provides a sense of stability and security, particularly for families offering a long-term place to call your own. It's a forced savings account. Each mortgage payment increases your equity, serving as a forced savings plan that helps build wealth over time. Leveraging home equity. As your home's value increases, you can borrow against your home equity to fund major expenses such as education, renovations, or other investments. Wealth building through asset diversification. Real estate adds another dimension to your investment portfolio, which diversifies your assets and reduces financial risk. Whew, that is a lot of benefits. Okay, so we just took a little bit of time to establish all the things that make up interest rates and the benefits of getting in the market now. But maybe you're still saying, but I just want rates to drop a little more. So I'll circle back to the beginning of this video where I mentioned that mortgage rate drops might not be the good news you're hoping for, because most people are looking at mortgage rates and want them to go down so their monthly payments are lower. However, a lower mortgage rate can sometimes mean the exact opposite for buyers. Here's why. When rates drop, the demand for housing often surges, causing home prices to increase as buyers flood the market. You could end up paying a premium on the home itself, which cancels out any savings you thought you were going to get from a lower rate. So even if you are getting a better interest rate, you might still end up spending more after all. Interestingly, even though mortgage rates have recently dropped a full percentage point from where they were a year ago, we've only seen a slight increase in demand for mortgages. This trend leaves a lot of uncertainty uncertainty. How long will this last? Will the demand stay lukewarm, or are we on the verge of a surge? Honestly, it's anyone's guess. There's no magic number where people feel confident enough to jump in all at once, though many experts are trying to predict it. But here's what we do know. The number of households being formed is steadily climbing, yet homeownership rates have not kept pace. Why? Affordability. It's a huge roadblock. High home prices and rising costs of living have kept many buyers on the sidelines, watching and waiting for rates or prices to become more favorable. If one of those two levers moves, either prices or rates, then it's quite likely that sets the stage for a major shift. If mortgage rates drop low enough to ease the affordability burden, we could see a massive surge of buyers flooding the market. We've seen what happens when this scenario plays out. Prices go up, sellers stop negotiating, and competition heats up. That house you thought you were getting a great deal on could end up costing more simply because there are too many buyers chasing too few homes. So how certain are you that waiting for rates to hit that perfect percentage is actually the best way to get the deal you're hoping for? Sure, you might get a lower interest rate, but if the market surges, that could end up pushing your monthly payment higher than you'd expect. So just out of curiosity, what if instead of timing the rate, you focus on what works for your personal financial situation right now? It could be the key to securing the best long-term value and avoiding the scramble when everyone else jumps in. And here's what that looks like. Right now in this market, you have opportunities to negotiate with sellers, opportunities that might not be around if there's a surge of buyers later. Sellers today are more likely to offer incentives like temporary rate buydowns, which can significantly lower your monthly payments for the first few years of your mortgage. This gives you the breathing room to hold on to more of your cash and potentially refinance later if rates drop even further. Another key advantage, many sellers are offering closing cost assistance. This means you can keep more money in your pocket up front, reducing the out-of-pocket expenses that often make buying a home feel overwhelming. You can use that extra cash strategically, whether it's for future home improvements, boosting your savings, or putting yourself in a better position to refinance if rates fall. You might also have more negotiating room on the price itself. In a slower market, sellers are more motivated to close deals, and they may be open to reducing the asking price or including additional perks. And if you're worried about rates falling after you buy, remember you can always refinance later. Many buyers get stuck in the mindset of waiting for that perfect rate, but locking in a home at today's prices with seller concessions means you are still in a stronger position when that time comes around to refinance. You'll have built-in equity in a home you secured at a time when sellers were willing to deal. And one more thing, by acting now, you can avoid getting caught up in bidding wars that inevitably happen when the market heats up again. Right now, with less competition, you have time to weigh your options, make smarter decisions, and secure a home that fits your needs without feeling pressured to outbid somebody else. So the real question is, do you want to wait and hope for a better deal while the market becomes less buyer-friendly? Or do you want to take advantage of the current landscape and negotiate your way into a home today that works? And sellers, I have something for you too. If you're a seller thinking about waiting for buyer demand to go up to get a better price, I get it. It sounds like a really good strategy. You may be hoping to hold off for the market to shift so you can see your home value rise. But here's the catch. You buy in the market you sell in. And that decision plays a huge role in your financial outcome, especially if you're looking to buy a more expensive home after you sell. Let's break this down. If you're selling your $400,000 home and plan to move up to a $600,000 home and you're waiting for the market to go up by 5%, and it might seem like a good idea because you'll make an extra $20,000 on your sale. But here's the flip side. That $600,000 home will also increase in value, meaning it'll now cost you $630,000 on that 5% growth. So while you made $20,000 on your sale, you're paying an extra $30,000 on your purchase. So you actually end up losing $10,000. And if you go back and listen to all the benefits for buyers who decide to buy in this market right now, well, you get to take advantage of that too on your next home purchase. And one final thought. Inventory is still low. Though we are starting to approach the same inventory levels we had right before the pandemic, we are seeing that homes that are priced reasonably with the market for their condition get sold. When more homes hit the market, you'll have more competition, and that could drive prices down or lengthen the time your home sits on the market. So before you decide to wait, ask yourself, do you want to sell in a market where you can negotiate and buy smart, or do you want to risk losing that opportunity for the chance to make a little more on the sale only to pay even more on your next home? So the takeaway I want to leave you with is, as we head into the last quarter of this year, the housing market is still full of wild cards that could change everything for buyers and sellers. Economic conditions are constantly shifting. And while it is easy to get caught up in speculation about what might happen with interest rates, home prices, or buyer demand, the truth is no one can predict the future with absolute certainty. We have a lot of factors at play: ongoing inflation concerns, unpredictable shifts in the stock market, and even the global economy impacting buyer and seller confidence. And while these elements can create a lot of noise, it is important to remember this: buying or selling in the market you know today is the safe choice. Why? Because right now, you know what it will cost you. You can see the mortgage rates available today. You can understand the home prices in your market, and you have the ability to calculate your financial situation based on the information that's in front of you. That's not a gamble. That's making a decision with clarity. Waiting for what might happen in the future is a risk. We don't know if mortgage rates will rise or fall. We don't know how buyer demand will shift or how home prices will respond to the economic conditions we're facing. What we do know is that making a decision based on today's market gives you the power to act confidently with all the facts in hand. So whether you're a buyer looking to lock in a home and start building equity, or a seller ready to move up or downsize, acting now means you're making an informed choice. The market you know today is the market you can navigate with certainty. Anything else is a roll of the dice. And at the end of the day, the best time to buy or sell is when it makes sense for your financial situation and your goals. If the market feels right for you now, there's no reason to hesitate. You're in control, and that peace of mind is worth more than chasing any unpredictable future. So as we wrap up, remember, you don't have to try to time the market perfectly. Time in the market beats timing the market. And knowing the landscape today puts you in the best position to make your smart move for your future. So if you liked this video, be sure to subscribe to this channel. I'm Jennifer Shannon. I'm a broker associate with the Crestage Group at Keller Williams Rockwell, and my team and I would love to be your real estate resource of choice. If you're looking for a real estate agent, we would love the opportunity to earn your business. We have 3 ways you can connect with us. You can reach us by phone or text at 214-803-4444, or send an email to me directly at jshannon@kw.com, or go ahead and book a free introductory call with us through the link provided in the video description. And if you are not in one of the areas we serve, we can connect you with one of our top producing referral real estate agents. Well, thank you for watching this video. I look forward to seeing you in the next one. Bye. This information is for general informational purposes only. The views, thoughts, and opinions expressed in this video should not be construed as specific financial, economic, legal, tax, or other professional advice. This information is provided without any warranty or guarantee of its accuracy, completeness, timeliness, or results from using the information. Receipt of this information and corresponding guide does not create an agency relationship with the provider. The recipient is encouraged to seek professional representation from a qualified lender, realtor, CPA, attorney, or other relevant professional before making any decisions based on the information provided. Real estate laws and regulations vary by location, and the information in this guide and video may not apply to all regions or situations. Always consult with a local professional to ensure compliance with all applicable laws and regulations. The provider assumes no responsibility or liability for any errors or omissions in the content of this video and corresponding guide. Any reliance you place on such information is strictly